A new court filing shows a clear shift at the end of 2025. Corporate bankruptcies are rising again, not suddenly, not evenly, but in a way that matters for what comes next. This is not a consumer story, and it's not a job story yet. This is a business side signal, and historically, it shows up before layoffs, before credit stress becomes visible, and before households feel the full impact. According to federal bankruptcy court data and restructuring trackers, Chapter 11 filings accelerate in the final quarter of 2025. Mid-sized firms are overrepresented. Filings are concentrated in a specific sector, not broad-based. This is not a repeat of pandemic-era bankruptcies. Back then, failures were driven by sudden shutdowns. This wave looks different. It's lower, more selected, and tied to financial conditions, not demand collapse. The increases are showing up most clearly in retail and distribution companies with thin margins, logistics and transportation firms facing higher fixed costs, healthcare providers squeezed by labor costs and reimbursement delays, manufacturers that refinanced debt during the low rate period and now face a rollover risk. Notably absent so far in major consumer brands, in large banks, tech platforms with strong cash reserves. That matters. So this is not a systematic crash signal. It's a pressure point signal. Three forces are converging. The first one, debt maturity timing. Many companies locked in short to medium term debt between 2020 and 2022. Those obligations are now coming due, a much higher refinance cost. The second, cost structure reset higher. Labor, insurance, compliance, logistics. These costs did not fall with inflation headlines. They stay elevated. The third will be demand normalization. Revenue didn't collapse, but growth is low enough that weak balance sheets were exposed. This combination doesn't hurt strong firms. It breaks marginal ones. Bankruptcy filings are not the end of the process. They are the start of restructuring. Companies typically renegotiate debt, close locations, cut investment, delay hiring. Employment effects usually lag by months. That's why this indicator matters. It appears upstream, before unemployment claims move, before consumer credit stress becomes visible. This does not mean an immediate downturn, but it does change the risk landscape. When businesses' failure rise, job stability becomes more uneven. Wage growth slows in affected sectors. Hiring becomes cautious, not expansive. For households, this shows up quietly, not as a shock, but as fewer opportunities and less margin for error. Three indicators now matters more than the headlines. Whether filing spreads beyond current sectors, whether the restructuring turns into liquidation, whether credit conditions tighten for the mid-sized firms. If bankruptcies stabilize here, this remains a contained adjustment. If they broaden, they become a leading signal for labor market changes in 2026. Corporate bankruptcies don't make daily headlines, but historically, they explain why things changes later. This is one of those moments where the data shift first and the impact follows. That's what we're tracking here. Thank you for watching.